take a moment to introduce our guest and so as to set a backdrop for today's discussion. So today we have with us Harish Krishnan, sir. So a senior fund manager, equity at Kotak Mutual Fund. Sir has got over 20 plus years of rich experience, and he had been associated with the Kotak Mutual Fund since 2005. Initially, he was based out in Dubai and Singapore till the year 2013, and then on from 2013 onwards, he has been like part of domestic mutual fund team at Kotak. So, as far as his education is concerned, he is an engineer, and later he did his MBA from a reputed institute, IIM Kozhikode, and he is a CFA holder, and he has been featured as one of the top rated fund manager multiple times for long term risk adjusted returns. So today he'll be speaking about his investment style, how it has evolved over a period of time, and what is the importance of having a process which is rooted in first principles, which is the today's topic of discussion. So, Harish sir, in case I missed out some part on your introduction, I would request you start with your introduction and how you started your journey being an engineer, and then how you dealt towards MBA and then later moved on to equity. So, would be great, and how your investing style has evolved over a period of time. Over to you, sir.
Thank you so much, Prince. This is my first Twitter space, so which is why I'm kind of struggling in terms of how and when and why to join. So apologies for all those naive questions to you, Prince. Uh, it's quite a privilege to connect on this format, and it's given the varied audience. I'll try and keep it, as my evolution as an investor, and then we can try and up or down depending on the questions that follow, etc. So let me give you a sneak peek as to what got me excited into markets. As Prince rightly said, I followed the very conventional approach that most middle class Indians did, which is to do an engineering, then join an IT firm, and then do an MBA. So I don't think there's anything different from that perspective as to how majority of middle class Indians with my background do it. In MBA, of course, whether you believe it or not, my main major was in marketing and strategy, with finance as a added major on. And I was always keen while I've always been very analytical and a numbers guy. I was actually far more keen on marketing as a opportunity from a job point of view. And luck had it that Kotak came into our campus. I've been a kind of a first ranker all throughout, but Kotak was the only company that came onto campus which I slept off during the pre-placement talk, and I had no idea what the role was. But then I got in, and then when I got about 4 5 offers on from campus, I thought that this was the most varied job, because I didn't understand what it was, even though I knew a lot about finance, but I didn't know exactly what the job entailed. And I thought, all other jobs I can always try and get back into. This is a job possibly I'll not get in. So it was more serendipity and luck that made me to come into this role. And I can only thank my lucky stars that I got this break, especially into buy side. It's not very easy for many people to get into the fund management or into the buy side very early on in the career. And I was, like I said, very fortunate to get there. Having got there, maybe let me try and give you a sense as to how my journey as an investment professional has evolved. and then maybe I'll let Prince to follow it up with any questions on this as a segue, and then maybe I'll move on to first principles investing. So. The typical MBA 101 approach was, you have to be very good in DCF, you have to master Excel sheets, you need to know Monte Carlo simulations, etc., etc. And clearly, a lot of my projects, etc., were in all of these. But there were two things that were taught to me in my B school that I will never forget. And they were by two practitioners. One was Professor Rajesh Tiwari, who used to practice with UTI at that point of time, and other was the great Mr. Manish Chokani, who came and took us a course on investing. So I was very fortunate that I was taught by these gentlemen. But the two things that stood up to me when they taught, and I never understood it at that point of time. It's only as my investment journey evolved that I realized that those were the two most important things. The first thing that they impressed upon me was an assignment that they gave. And they said that the assignment is very simple. That you are all in your 20s in your MBA. You all get different jobs, go on to various companies, make a reasonable amount of money, and at 40 you decide to retire, and then you go to the Himalayas. You have to identify one stock that you will invest when you are 40, and that you will encash out when you are 60. What would that stock be, and why, and how do you value it? So this was the only case study stroke assignment that this entire course entailed, splitting us up into groups, etc. And I mean, at that point of time, of course, the fad of the time was pharma, and names like Ranbaxy, etc., were making multiple time highs, etc. Or IT, that was again something which was the fad at that point of time. Now, over the course of the assignment, the key aspect that they focused on, the professor focused on, was the longevity of business. So survival is the most important aspect in investing, was taught to me very very early on by the practitioner professor, and for which I'll be forever indebted, in terms of drilling into this aspect, that how do you know this fad is going to survive 5 years, 7 years, let alone 20 years? And when you start thinking in that, you understand that in your typical compounding formula, which is the principal into 1 plus r exponent t. T does most of the heavy lifting, and therefore it is important that you need to identify companies which add value over time. So this was, I think, the first facet, and like I said, it wasn't that I understood the gravity of what they were trying to impress upon me at that point of time. It took me 5 7 years to understand, and my own share of mistakes to understand what it is. The second set of insights, or practitioner advice that they gave to me at that point of time, was as follows. They said that you will have to take a decision in investing, assuming 65 or 70% of all available information. As a minority investor, you are never going to get complete information at any point of time for you to decide that, okay, this much information is enough, and therefore you need to decide. It is always shades of gray. It is a probabilistic endeavor. And what they kind of drilled into us was, to get from 0 to 50% of information is child's play. And today, of course, 20 years post that, given the amount of information that's available on Twitter, various forums, WhatsApp, social media per se, screener, etc. It's essentially child's play, and they are great, fascinating tools that take us there. So essentially, public disclosures, etc., which is already available, right? Now, to move from 50 to 65 or 70 is where your edge or your success is going to come through. And for that, they actually had in the same assignment of the case study of 40 to 60 years, they had the same assignment. They said that imagine that you had the management for one interaction. What were the five questions that you will ask that will convince you whether to invest or not to invest? So that at the end of those five questions, you will go from 50 to 65 or 70%. And then you have to make that decision. I think both of these were very profound. I know I'm using that word very often in the last 5 minutes, but even today, when I think of the gravity of what they kind of told, I was like, I'm literally forever, thankful and grateful for this advice. Having said that, while these were great sets of advice, starting out as a fresh MBA, you still believe that your biggest strength is knowing your Excel sheets and finding to the second decimal point what the interest rates in your weighted average cost of capital is, how you're going to move, the various cells, and how you're going to combine the balance sheet with the profit and loss, etc., etc. Right, the typical drill that you see in equity research at most places. And I set out with the same objective that accuracy is the most important thing. And the first, so there have been four light bulb moments in my professional career. Four moments wherein I felt that, a if only I had not, if I only had started doing like this instead of doing how I was doing all this while. So the first phase of my life was, like I said, the typical engineer analyst, focused on the numerical aspect of it. Uh, and over here, I got into the job at Kotak. It was for the offshore funds. And it was a totally liberating experience that, as a 25, 26 year old, you could go and meet a CEO and or to a factory shop, and they would be wanting to answer your questions. It was like nirvana for me, that why would somebody who spent 30, 40 years in their career even want to entertain me? Right. But that was a phase that I would call, in looking back, reflecting upon at that time, which was the cowboy investing, which is basically you go meet a company, say the sugar sector, you like it, next day you buy it. And you know what? That was the time period where such risk was rewarded. And of course, I'm sure you must have heard of terms like, invest first, investigate later, etc. Those were really the heady days where, you could get away with investing like this. And believe it or not, that was making a lot of money. And therefore, it felt that this was the right way to do it. Of course, we all know that that's totally the wrong way to do it. And therefore, I made a whole bunch of mistakes. Names I'm totally ashamed of ever being associated with today. They were all littered, in my portfolio at that point of time. And essentially, while the focus was on arriving at DCF values, etc., there wasn't too much focus given on the quality of the management. Even though, the professors had taught me about longevity, etc., it was always about, okay, can I get the next quarter right, or the next two quarters right, the next year earnings right, and that's what will get rewarded, etc. It was, in hindsight, the worst set of learnings to pick up from that point of time. But in hindsight, it was the best thing to have happened to me, because I made a lot of mistakes very early on in my career with very little capital in a professional setup, not on a personal level, because I have never done personal investing. It was always on the professional side. Then, of course, as we all know, 2008 happened. It was like a wake up call. And then, no qualms about it. The portfolios that we had built got decimated, to put it mildly. And it was unfortunate, because that is when we got to see the human side of investing. When we used to go and meet investors, and then we really understood that, it's the trust of investors that matter the most. And it was extremely embarrassing that we had lost the trust of the investor, and to win that back has taken a good 10, 12 years, I would imagine, for us, or at least for me. But the next phase of my career was, I would say, knowing the best companies. In hindsight, we were buying the greatest companies, the best quality companies, and still we were not making money. As a portfolio manager, we were kind of puzzled as to how is it that despite getting the stock calls right, we were not making money. And that is where over introspection as a team and as a self, we kind of stumbled on the fact that portfolio construction is possibly the most important thing rather than stock selection. I mean, these all seem very obvious, but I hope you don't think that we were running with people's monies, etc. But I guess this is the nature of investment, right? We make a lot of mistakes, unfortunately. The important thing is we don't repeat those mistakes. The point was that that was a phase which was actually the toughest phase in my career, wherein even though we were doing the right thing in terms of identifying the best companies, etc., we were still not making money in a risk-adjusted basis for our investors. And that was a phase I would think that led to a lot of self introspection and questioning, and which is where the third phase came in, which is to bring in the risk management framework. And a lot of people hate risk managers in a team. To my mind, I think it's the best thing to have happened, because it clarifies the boundaries, the edge conditions, and therefore it ensures that your focus is not diverted out of what you can't invest. Simplicity is a great virtue. Our business is extremely complicated. If you want to make it complicated, the more we simplify, I think it's a great thing that can happen. And that phase, of the next 3 4 years was a phase wherein we ran risk management as the cornerstone. We got the cash flow based investing right, and that gave us a lot of confidence that we were in the right path. The third light bulb moment came to me, which was in terms of focusing on quality, focusing on longevity. By then, all those things that my professor practitioners had told me maybe 10 years back started getting drilled into it, made into process workflows, so that we don't make those same mistakes. And the last light bulb for me, and obviously the journey is still evolving, I'm sure there'll be many more light bulbs for me, has happened about 4 5 years ago, wherein I started looking at quant in a completely different lens, which is to complement fundamental investing so that the narrative based investing that we are all exposed to, wherein we meet a company or we like a particular idea or we like a particular theme, and how to not get carried by it. And that is where quant came as a big support for me. And the last 4 5 years, that is where I've kind of embraced it in our own style. So this broadly has been my journey. I know it's taken longer than you would have liked, Prince, but yeah. So these have been the 3 4 light bulb moments, and kind of have these collective experiences have shaped my evolution and have brought me to this place wherein you can say that today I think that from a process point of view, I would think that first principle investing is my preferred way of looking at anything, be that of a stock, be that of a portfolio, be that of risk management, or be that of common sense investing. So I'll kind of stop here, and then maybe I'll take it as the next segue to first principle investing, if you want that.
Right. So Harish, like I assume, like you started in the year 2005, and like 2 3 years down the line, 2008 happened. So those years like ought to be painful for every fund manager also. So how had been your experience during those times and consequent like pain periods which followed after 2008 also?
So, see, I mean, please, I know I am a professional, okay, and so this is purely for education. So, I don't want to be quoted out of context here. So, obviously, there's a lot of hurt there is a lot of angst. And there were days, I mean, between the period. So when 2007-8 happened, I think the biggest feeling I had was that I was embarrassed to stand in front of the client and to look at the portfolio. Initially, there was denial. When stocks that were going up suddenly fall 20-30%, you like saying, "Oh, this is a good buying opportunity." Right, and therefore you try and again create the narrative. No, no, it was available at X, and so you get anchored to the price. All the common mistakes that we keep hearing about it now, I firsthand did them, and today I can say I'm ashamed to have done that. But like I said, the idea is if you don't make these mistakes, I don't think you'll be a better investor. So please view my comments from that perspective. It's not that we were playing with people's money, etc. It is the journey that we took at that point of time, which is how it turned out. Right, 2008 to 10, like I said, was the toughest phase of my professional career, wherein every day we would look up, we would look at our face in the mirror and we would be wondering, what the hell are we doing? Why is it that our portfolios are not working? And that was, if at all there was one time wherein I felt like quitting this industry, it was during that period of time, to be honest. That was the time wherein I thought that, maybe I'm not cut out for this industry at all. Because whatever I'm doing, it doesn't get rewarded. Unfortunately, feedback loops in our industry are when prices keep going up and you take the feedback loop of what the price is saying. Market is right, but it's also important to know that decisions that we make in our portfolios today ideally will see an impact maybe 1 to 2 years or maybe 3 years later. The collective decisions that we take. It's unlikely that the decisions we take today, the efforts of or the outcomes will reflect, say, 3 months or 6 months down the line. And I thought that at that point of time I was looking at the 3 6 month feedback loop and got extremely frustrated. Um, Post that, I like I said, maybe we've got just plain lucky from 2010 to 12. Maybe the mistakes that we did made us stronger, made us realize of what not to do. And post that, of course, there have been moments where it's frustrating, you're not getting the calls right, etc. But I guess that equanimity kind of comes through, and you realize that that's not. And then whenever these light bulb moments come through, that is when you realize that this is a tool that can help through. So yeah, that's how my personal feelings were at that point of time.
So Harish, like, would like to understand, like, when we are meeting, say, you are meeting a company management, so as to understand about the company, as you were saying, like, if you have to move from 50% to 70% information. So what all you look for, and how the preparation before that goes? Because if we are going for a scuttlebutt or maybe meeting a management, so we should be all prepared, and we should be like seeking information which is not already, I mean, available, or so how exactly like it goes, and yeah.
Yeah, no, I think it's a great question, and obviously it is contextual. It depends from company to company, sector to sector. But over time, with experience, we realize that, and basis experience that we have seen firsthand of other companies in various other sectors doing those mistakes. I think our primary focus is what are the mistakes that people are doing in various other sectors and how the management thinks about those mistakes. I think, in a nutshell, because when we are talking about 5 year, 7 year, 10 year kind of investing, we have to first ensure that the value gets added. I mean, the rate of addition, is it'll be great to have a very high compounding rate of addition, but the first thing is it should at least be somewhat positive. Even 1.01 raised to the power of something is a phenomenal compounding machine if you give it time, right? Whereas 0.99 raised to something else will erode value. So our key focus is the edge is the competitive edge, getting eroded, or is it getting sharpened? And what is it that companies are doing to sharpen it further? That is a common source of questions that we look at. The second thing that we've kind of realized, and now of course it is common sense, but it took a time for some time for me to realize, is that obviously the cash flow statement is greater than the balance sheet statement, greater than the income statement. There's no point, whereas most of us focus on the income statement, then some afterthought into the balance sheet, and then finally into the cash flow statement. And what we've realized is that markets are excited by growth, for sure. But more than anything else, we want companies or we want managements that don't necessarily have to rely on the mood of the capital markets to finance their growth aspirations. And therefore, we tend to look at the last 5 years, the last 7 years across a cycle. Of course, for different companies and sectors, the cycle periods may be different. And we look at the collective cash flows that they've made, and is it enough to fund their capex? And then we look at the concept of the incremental return on invested capital, which gives a sense whether the companies and management teams are actually focused on retaining their ROICs or further improving their ROICs. So I think it is in these set of managements, very rarely we focus on what the next quarter will be, or very rarely do we focus on if there's an event that is happening. We would want to spend a lot of time. Sure, these big questions take maybe say 40 minutes, 45 minutes of the interaction. And then, to kind of fill time, we try and bring in these other questions, which are more the 6 month to 1 year or 1.5 year kind of a thing. And I think, by and large, we hope to arrive at a probabilistic end to our answer by the end of the interaction. Of course, it's an iterative process, to say the least. But yeah, those are the broad areas that we focus on to help improve our decision making during interactions.
Right. So we also got Ravindra Bhandari. So Ravi, you can go next.
Hey Harish, thanks for sparing time for discussion. I was asking if we can talk about some sectors, we want to avoid sector discussion.
See, I would prefer it to be an educational aspect. So, as long as the question is not about a sector today or how it is looking today, if it is purely from a of the past, etc., I'm happy to discuss to further clarify the point.
Yeah.
So, I hope you understand where I'm coming
Yeah,
from,
yeah, yeah. That's why
because
I
I
asked. I
don't
didn't
want
mean to
any.
continue also. I understand. I
Yeah.
completely understand and appreciate that. When you say that you look for long term, and if you find that company is taking time to deliver on the promises and the sector is not performing as position were earlier, how long you think that, how many quarters it's okay to see that company will come back? And because we always have this time frame also in mind, to how do you judge on that? Okay, this is 6 months or 1 year. I'll see how the company perform or get back on track. Else I'll
Sure.
have a different strategy.
Sure. So I think this is like the heart of investment process, which is the selling discipline, or the thought process of evaluating when something goes wrong, right? And to be quite honest, I'll give a 2 minute response after this, but the short response is it is still work in progress, and I don't think I have the authority to say that I have arrived at this to be the ultimate holy grail. But my thinking is as follows. which is basically, I would think that 1 2 quarters is any which case too short a time frame. We definitely want to give it a lot longer than 1 2 quarters. That I think goes typically with 95 99% of our investments. But there will be for example, as long as incremental ROIC etc is tracking on the same way, I would say that we are generally okay. Where we get a lot more rattled is when the stories or the narratives spun by the management keep shifting every 3 6 months. They give a particular reason why things didn't work out, then 3 months later they add another reason or they modify their original reason, then another 3 months later they further modify. That kind of rattles us the most, because then we know that we are in a slippery path wherein we don't know whether we can really trust. And obviously, there have been many such occasions as well. It's not that we have not made mistakes on that count over there. Generally, I would say that we tend to give, so it's on record that our portfolio turnover is like 15 20%. So we typically tend to give between 4 to 5 years for companies. Some companies, we've held on for 8 10 years. Some companies will hold them for 1 2 years. My preferred approach is when things are not going your way, not to buy anything additional, because we typically, whenever we make a new position, we start out small. It'll be maybe 1%. We are not concentrated investors in most of our portfolios. Of course, we have got some focus funds, but by and large, we are diversified investors. So we start out small. As we get greater confidence, we then scale up positions and we let the winners run. Yeah, so by and large, that's what has worked for us. But definitely, there is a massive room for improvement, to say the least.
Great. I have another question. This is more generic kind of in our rising interest rate scenario. How you judge how much? I don't know if you put bucket for the debt or high dividend going up
Uh,
and may stay up for a longer duration. So whatever cash flow we were projecting earlier, that might come down. The first reason for that is interest cost and other cost of business is going higher. Another is our discount rate. So there is a double whammy on that. So how you are uh, putting your
so,
thoughts?
see, at least my thinking is that does the interest rate or does the cost of debt differential? I mean, I'm a big believer in relativism than absolute thing. So, if everybody in the sector is worse off by a common event or a common denominator or by a common macro factor, what matters is the delta difference that this company has over others, and whether that delta can meaningfully change the mind share, market share gains, and the overall competitive positioning of that particular thing, right? So, as long as that doesn't get impacted, we think that we would be okay with interest rates moving up and down. Thankfully, unlike the West, our interest rates have been reasonably range bound. I mean, it's not that there have been companies which have got very low cost of capital, or at least the scale of difference has not been like what we've seen in the Western world. So therefore, by and large, barring of course the valuation angle of discount rates impacting, but that is not something that the companies can do anything about. For us, therefore, the call is: do we use the opportunity to further add, or whether we want to wait on the sidelines and see some other sector that can do well at that point of time? That's the relative call. But at least I have never really taken any action because of such commonly disturbed macro variables, which will impact everyone in that sector.
Understood. I'll have one last question and then I will pass to Prince again. Say in this interest rate again, now this is more I would like to know your to where you say that interest rate is very high and it is hurting business, it is hurting investment environment on the one side, or on the other side, we have supportive to the businesses and spender for at least 20, 30 years. What about having 2, 3 years for the savers to have their ride as well, to have that this kind of high interest rate on a global level? India difference hasn't been there. We always had high inflation, high interest rate. So for us, it doesn't matter much until unless anyone is superbly levered. But on a global level, where you want to put your thoughts?
So I still am in the thought that we have a savings glut. So I don't see really a solution to that. So I I mean my personal view is that interest rates are unlikely to last very long high up there because world economy, world productivity is very poor, very low and declining. Despite advances in technology, if you look at US, productivity levels have come off. India is actually a surprising example where productivity has actually improved quite meaningfully compared to the rest of the world. But therefore, India is an exception. Be it in China, be it in US, which is otherwise the poster child of innovation, productivity levels are coming off, and we all know that population is stagnating in many places, declining in a lot more advanced economies. So I would be very surprised if interest rates can last for very long. I mean, it's a great thing for savers that they're getting these global interest rates. Now, whether they will start trending down 6 months down the line or whether they'll stay here for another 1 year, 1.5 years, I guess only time will say. So, I mean, I'm not of that camp, at least, and maybe I'll change it over a period of time. That there are a lot of people who say that 1980 to 2016 or 2020 was a one-way street where globally interest rates collapsed and therefore everything got reflated, blah blah blah, and the next cycle is going to be a super cycle or a regime shift wherein we are going to see a completely different interest rates. I mean, I see very little evidence why interest rates are likely to be much higher. So at least that's where I'm happy to elaborate if this doesn't clarify, but at least that is my thinking.
No, no, that's fine. Yeah, I guess Aditya is also here. If Aditya want to ask something.
No, I just wanted to listen into Krishnan and Harish. Just one question for you. I think the past decade we would agree that money was largely chasing growth. So we saw certain high growth stocks attain Ps which were astronomical, at least in my view, and value sort of tended to outperform. And I know value doesn't mean X growth. I mean value with moderate to low growth actually outperformed significantly is what I understand. So I wanted your take on what the next decade could look like for the so-called growth and value stocks, and where would your tilt be in your investing style? Thank you.
Sure. So I think I think you will also agree that value and growth are often confused and possibly abused quite significantly. But I mean, I get the drift of your overall question, which is that are we going to see an abundance of scarcity premium, wherein the more expensive and the more consistent names will get even more expensive, or is it going to be a return of the real economy and the value, etc., or those kind of businesses which are possibly trading lower than their average valuation. So clearly, gravity does act as eventually it does play a big role. Even if the really high price don't correct, they could see a humongous amount of time correction which could last maybe decades, wherein finally people throw in the towel and say that it was a mistake completely there. So from that aspect, I would think that overcrowded and under invested is, I would say, a better framework that I would look at rather than looking at growth vis-a-vis value from the traditional lens. The second thing, my thinking is that value typically tends to do well when growth scarcity comes off. What I mean by that is What we have seen over the course of the last 10 years is one is, of course, as you rightly pointed out, money chasing growth. But the reason why it chased growth, in my opinion, is because the scarcity of growth, because the number of companies that were reporting, say, 10% plus growth in a global level, and even in India, and this is data that I've actually shared in the public domain in terms of the number of companies which are reported 20% ROE and 10% EPS growth, have actually plummeted even in India compared to what it was, say, in the previous decade. And so, am I going to see a revival wherein we are going to see a whole bunch of stocks showing growth, which is going to be significantly higher than and take us back to the 2000 to 2007 or 8 levels? I am not so sure. I don't think. I still think that growth is going to be scarce. It Because the overall macro environment is tough. It isn't free for all. It isn't like all gangbusters going up, and therefore it is going to be selective. So the point I'm trying to make is, if the earlier growth bubble was very selective sectors getting the benefit of that tailwind, now I think a whole bunch of other sectors will also get the benefit, but it is still going to be only one or two stocks within each of these sectors which are demonstrably showing growth consistently. They'll get chased. So I think, therefore, what I'm trying to say is, today, if I were to look at, say, the percentage of stocks which are at 2% plus yield, it is at 33%, and this number was at 5%. Right. So we've seen a mainstreaming of valuation creep rise significantly in the Indian context. I think this number will come down. It'll go back to the 20%, but will it go back to the 5% level? I don't think so. I don't think we are going to go back to that regime. So I don't know whether that kind of clarified or confused. Happy to engage in further conversation on this.
No, that makes a lot of sense. And I agree with you. I think growth scarcity would remain given the consolidation that we are seeing across multiple sectors. And
Right.
there will be few large winners. That there I think we are in agreement. Another question I had for you was, as you were pointing out, obviously uh, there's something that the companies can't do much about, which is the rising interest rates. So obviously, as investment managers, we can stay away with from companies with leverage, but at the same time, the discount rates for cash flows go up, and therefore multiples would squeeze. I mean, just as a corollary, theoretically speaking. So, in your framework, in your understanding, would you see some of these, high or expensive valuation stocks getting time corrected over a period of time till their PE starts making theoretical sense, or do you feel that because of the scarcity, in growth, these high PE stocks or these sort of high growth stocks would remain high PE and high growth, and therefore continue to compound for some time?
So I think in the Indian context, Aditya, there are two kinds of high PE stocks that I see. One is the low growth but high quality high PE stocks, the FMCGs and the likes, right? And then there is the genuine high growth, and the high PE stocks. My sympathy at least is with the high growth high PE stocks. There still is a lot more sense that they can continue to remain where they are. But the high quality, the only reason that people believe that the next 15, 20, 30 years their modes of distribution etc will not be broken, I think those will get challenged. The ROEs of those companies, I would think, are likely to see a lot more challenge upon, because especially when you look at many of these, obviously even within that there are some very well run franchises, but there are many others, just because they are in FMCG or just because they are in a particular sector, they get traded at a high P without the management or the company exhibiting any innovation, exhibiting any reason of why their ROEs should sustain at these levels, other than the fact that they are a 100-year-old company and have got a great brand. And even there, they are not doing. So I think those ones will definitely get challenged down. It's my view, and newer names will come through which will exhibit higher growth. And I think my only disagreement is, I don't think that interest rates, in my opinion, beyond a point, will matter in this choice. Ultimately, markets like to be excited by a particular narrative. Of course, a higher interest rate means people obviously can invest in fixed income or other alternate products. So that amount of flow can go away. But within the basket of equities, are people going to suddenly fall in love with cheap names just because they are cheap? At least my limited investor psychology thinks unlikely at this point of time.
Right. Thanks a lot. Thanks a lot.
Thank you, Aditya.
Thanks, Aditya sir. So there are a few requests I couldn't take, maybe due to glitch. So those guys can surely write their questions in the comments. I read it out to Harish. So Harish, like the pressure of performance, like how you, I mean, maybe when you started and during the period of your last 20 years. So how had been your experience with the like pressure of performance and client communication, because both are very
Sure.
important in my view.
Correct. So, see, investment is not a popularity contest. I think the sooner we all realize that, the better our outcomes, both as managers as well as for the client outcomes are. So, anything which is easy to buy into, just because the world is buying into, and, you're going to get praised for it, or at least you're not going to face flack over it. I think at the end of the day, you're not pushing yourself, and therefore outcomes are going to be poor. Um, I think obviously the performance pressure is forever, right? I guess this is the reality that as a professional, you have to you need to be prepared for this, and I don't think we can shrug away from saying that oh, if only I had this nice field wherein people are not going to look at me and my performance for so many years, then I would have given a great performance. But it's also therefore the point I'm trying to make is that investors, I think, in India are starting to mature. I won't say they have matured a lot. I've worked in the offshore side, wherein I've experienced a lot more maturity. People there are very clear as to why they are getting into an asset class. By and large, obviously there are poor investment allocators even there, but by and large they are clear as to why they are getting into. And as long as you convey to them a process, and you tell them that you did everything by the process, they are not that fussed about the outcome, in the sense that they are willing to tolerate that outcomes can get delayed because it's a probabilistic exercise. In India, of course, it still is return obsessed investors, though like I said, the maturity levels have definitely improved in my limited opinion, wherein people are willing to, thankfully, they started from trailing point to point returns, they have moved to rolling returns. Within rolling returns, now we have to tell them that, hey, look at it in any 5 year period. I have outperformed on 86% of the 5 year period in the large cap category, and then people are willing to listen to it. They're still not yet bought into it entirely, but I guess we'll have to move into that kind of a communication to try and explain that this is a probabilistic exercise, and therefore you need to look at it from that lens rather than looking at it from an outcome. And here on the input side, these are the 10 things that I'm doing, and I would say not everybody buys into it. It'll be naive of me to say that everybody loves this kind of a thing, but I would say that we are getting there. We are nowhere close to where I think the international asset allocators are. That's my personal view. I'm not passing judgment on the investors. Maybe I haven't met as many great asset allocators. Maybe, but I think we are getting there. And yeah, we'll have to deal with the pressure. I don't think even somebody who had 30 years of an illustrious career, I'm sure he had such tremendous pressure towards the end of his career. So that's the unfortunate reality of this profession.
So Harish, like what all challenges you I mean have you face, like managing across categories and such a large amount, say 25,000 crore across large cap asset classes and quant and thematic. So could you please talk about the challenges? you faced?
So I think the challenges are more behavioral, more than anything else, because see there are three edges that we can have, right, in the investment management industry. First is the information edge, second is the diligence edge, and third is the behavioral edge. On the information age, I think, by and large, we've never really been in that insider information quadrant, so to speak. So, and I think the industry is also moving out from that. So, I would say that by and large, that edge is going to get blunted very soon. So, over here, the information edge, as to how we are looking at improving, is to look at alternate data. And over there, I think over the last 3, 4 years, we have started to make baby steps in terms of how do we look at alternate data to improve our information edge. I mean, we are nowhere like the say the US hedge funds, which look at satellite data, etc., to see. But we have our own small ways of getting there. Let me put it that way. And I guess it's a relative edge, right? There is no absolute edge. Every year you need to get better. Every day you need to get better compared to the rest of the investment fraternity. And I think the overall edge is very small. But we are trying our best to try and improve that in whatever alternate data ways that we can. On the diligence edge, I think, if you look at most investment houses, by and large, I would say the team sizes and all that is same. Of course, the processes might be slightly different, but I would say it is the diligence, and which is where the first principles approach, which is to look at simplicity against complexity, to look at cash flows, to look at first principles against heuristics and thumb rules, etc. Over a period of time, I guess we've all evolved our thing. But the biggest challenge that I personally face, and which quant has helped me overcome, and which is what has kind of helped me through in the last 4, 5 years, is the behavioral challenges, which is that how do I react when markets are down 10%, 15%? How do I react when markets go up? I mean, how do I react when and these are things, obviously, in a theoretical or an academic setting, it's very easy to say that this is how one should react. But the reality is, I think emotions affect everyone at varying degrees, right? An amateur might have a different kind of a thing. A professional might have somebody else. A seasoned professional may have a slightly different degrees of freedom. And over there, I would say quant has really worked wonders for me. And I mean, the reason, and that is what I think has helped me scale up as an investment manager, so that I hopefully make lesser mistakes managing this money.
So, like Harish, you just talked about the mistakes, and we all make mistakes, and hopefully, like your journey would also not be free. And you said like making mistakes in early part of your career is a bliss, right? So, any such mistakes you want to talk about?
Okay, so I think the simplest mistake that we focused on is that growth is the be all and end all. That companies that keep growing will get forever rewarded, and which is like like I said today, when I reflect upon it, it is 101 mistake, which is that basically companies that grow ahead of ROE are going to constantly need capital, right? So if you keep growing at 25, 30% and you're not having an ROE which can support this 25, 30%, you're going to constantly need capital. And capital markets are a fickle animal, as we all know, right? Sometimes they treat you like you are the bird, sometimes they treat you like you are the statue. So and be it a debt manager or be it an equity manager, the moment you are opening up your balance sheet and your growth aspirations to the vagaries of capital markets, I would say that you are in a spot of bother as a company from building a durable longevity kind of a business. And at least in my initial stages, we were enamored by so many groups. Many of them are BIFR today. I mean, I'm not naming names for obvious reasons, but they were all showing growth which were like 30%, 40%. Stock markets were rewarding them, obviously. And this I'm saying in 2005, 7, which were very early on in my career. And that was a phase that got rewarded and obviously saw the biggest erosion in market caps. And that was primarily because the moment the market, be it the equity or the debt market, suspects your ability to refinance capital, the entire the virtuous loop that was going on becomes a vicious loop. And then there is no point in getting anchored. The second mistake that I had made that time was, oh, the stock has fallen 30% from its high, 40% from its high. Market gives a damn as to how much you have fallen from a high. The sooner, so I would say those were the most of my mistakes that I made early in my career across sectors, across business houses and groups, were all primarily this, that they were growing their EPS far in excess of their ROE. And the moment the availability of capital ended, that was the end. And in some sense, new age companies, etc. And this is something that I've published, so I'm talking about it. They were no different from the infra boom because they were hostage to the capital cycle, right? The moment you are hostage to the capital cycle, your chances of getting rewarded go up, but your chances of misery also go up significantly. So I would say that most of my mistakes were believing that growth is the be all and end all, and without focusing on the balance sheet and cash flow at that point of time, and that is what led to the inevitable collapse. I'm not saying that we don't make those mistakes even today. I think judgment calls always happen, but the quantum of mistakes definitely in that area have reduced quite dramatically.
Right, Harish. So, Harish, like obviously not anytime soon, but the people who are looking for investment with a view of say 3-5 years from here. So what structural stories or maybe the pockets which you are looking at, or maybe if you are comfortable talking.
So, see, I am a big believer that this storytelling on narratives on demand side is bunkum. In India, we are such an underpenetrated category in every goddamn category, right? People talk about, say, for example, toothpaste, which is one of the highest category penetrated. But today we brush as a collective population maybe once a day. Even that I doubt. But so if you move it to twice a day, we are talking about half the penetration. So penetration stories, I think, are the worst kind of investment thesis to hang your hat on. I would say that the bigger stories typically end up being on the supply side than on the demand side. Like I think Aditya pointed out, wherever there is consolidation, those are the sectors where durability of profit pools, sustaining and growing, can come through. And again, I'm just giving a sense of the profit pool share. Okay, and maybe my numbers are a bit off because I'm quoting out of memory. But if I look at, say, sectors like, say, cement, the broad profit pool shares have varied from, if I'm not wrong, 0.5% to, say, 2.5% of total profits. So when I say total profits, we are talking about, in today's time, 12 lakh crores of total profits. It's varied from 0.5% to 2%. And today you are at the bottom of that 0.5% over the last 25 years. Right? The sector is getting consolidated. Of course, there is this new player that has come through, but even then, the sector has got consolidated. And therefore, are the prospects that this 0.5% can become 1.5, 2, or maybe even 3% over the next 5, 7 years possible? As a probabilistic approach, I think it is quite possible. Of course, that doesn't mean that you put all your eggs into this. You identify sectors like this. Similarly, I mean, and Aditya, I think, is the expert out here. I would say pharma and healthcare is a space where profit pool is like a 15-year low when I look at profit pool as a percentage of total profits. And 5, 7 years ago, the narrative of pharma was all that, India is the diabetes capital, the heart attack capital, blah blah blah, and it's a perennial evergreen story that can always keep compounding. And now we are at the other end of the spectrum. So I again, please please don't look at these sectors in isolation. I'm just trying to give the framework wherein a lot of these sectors, it could be real estate, it could be home building, it could be investment. So I think when I look at it, consumption seems, overextended as a broad space, and investment is a space that is where profit pools have struggled, and that is where I think there can be potential surprises over the next 3 5 years. And within that, there are a whole range of sectors. It's up to us to pick and choose from and to back some of the better quality franchises out there.
Right, Harish. So, few questions in the comments. Rohit Bakare is asking, over the next decade, which stock market has better chance of outperformance, India or US?
Wow. uh, See, the home bias is definitely high for me. So I would say that, we understand the Indian market better. So I would still put Indian market to be a strong contender. Uh, but quite honestly speaking, and I'm not trying to obviate the question or move around the question, so don't get me wrong, but I don't think one should have a 10-year horizon in these calls, in my personal view. I mean, it's important to have a longevity, it's important to have asset allocation calls, etc. But these kind of calls, I would say it's better to have a 3 5 year kind of a sense. That's my view. And on that kind of a horizon, personally, I have no money other than in India and in US. But I would think that Japan has a very, very good chance of surprising. I mean, like I said, I have zero money there, so we don't have any funds in Japan, etc., etc. But I would say that I would be watching out for Japan, and it's got nothing to do with what Mr. Warren Buffett has done recently, etc. But even otherwise, I think that's a space where productivity levels are improved quite dramatically. The factors of production are very cheap. Cost of capital is still the most competitive and cheap. The cost of labor in the developed world is the cheapest out there. The cost of energy is reasonably okay, and they are an innovation powerhouse. So it is under owned, under loved, hasn't really created wealth after that big thing. So I would look out for Japan again. Like I said, all disclaimers. I own nothing, so no skin in the game. It's just talk, but that's where it is.
Right. One question is from Lakshay Agrawal. So he's asking, when you mentioned regarding the interest rate not going to sustain at higher levels. So basically, his point is like the higher interest rate majorly to reduce the debt to GDP of countries which are not sustainable. Any view over it?
No, so I think the point is right that you have a high inflation to reduce the potential, the debt to GDP, because you are inflating the denominator far higher than the fixed couponing that you do, because most of your debt isn't really indexed to inflation, right? There is, of course, a small category of inflation index bonds globally, but by and large, it is the fixed coupons of the past. And if you inflate off your debt to GDP comes off. So that's of course how we got out after the World War II in a global level. But I think the settings were very different. It's my view that that was a time when the world was much younger. Of course, there was a rebuild phase going on, and the whole of Europe was devastated. So it brought in that entire phase wherein growth could accommodate a lot of things. Today, if I were to look at it, growth is a challenge everywhere. I mean, India, I mean, 5 6% growth, but it might seem like we're doing great, but compared to what we can potentially do or what we should do, as a selfish Indian, I would think that our potential growth rate is much higher. But the reality is that the world is slowing down. It is a tough, challenging macro backdrop, and therefore, especially with population declines in many of the world, I would say that growth is going to be a challenge, and in such an cocktail environment, to believe that interest rates need to be sustained higher, I think will break a lot of things. So, which is why I think that interest rates will come off. Of course, it will come off because of some crisis or policy induced, etc. The key is, it'll go back to the ICU. once in the ICU, I think the central bankers and policymakers know how to sustain the patient. So I am of the view that we are not going to see a regime shift. Like I said, I don't think that interest rates are perennially headed higher, and we are going to see a mirror image of 1980 to 2017. Now we are going to see a completely mirror image. I'd be very surprised of that outcome if that were to be the case, say 3 5 years down the line.
Right. So we got two speakers to ask questions. So Kaushik, you can go next, and then we go to Investor Hub. Yeah.
Hey, thanks, Prince, for giving an opportunity. Hi, sir. I just wanted to understand. I saw your couple of interviews today morning. You were doing, your video was on the manufacturing side. So can I understand what actually you exactly like in manufacturing? And now today we saw one more. There was a company who was having all-time high, and it was on going on the railway theme. So how manufacturing are you analyzing, and like what are the key indicators that we need to track in manufacturing?
Okay, so without getting into specific sectors or stocks because of the various reasons that I've already outlined, see, why is it that we think that manufacturing, at least the confluence is right, and so it's still a probabilistic outcome. We think that there is a greater chance of the investment bets coming through. So I think that for anything to do to look at, we look at the factors of production, right? And whether our edge in these factors of production, are they getting better or are they getting diluted with time? And when I look at the factors of production for investment or for manufacturing, broadly, if you look at capital, labor, tax rates, currency, energy, and reforms. These are the 5 6 factors that impact manufacturing at any point of time, right? And if I look at each of these factors, I would think that the delta improvement is quite meaningful, which makes me positive that we could see an investment outlay improving. So let me quickly spend some time on each of these 6 dimensions, and then we can take any follow-on questions on this. So if I were to look at, say, sorry, capital. Now, obviously, we have all lamented the fact that India is a high capital country. Just to give you the context of the numbers, the total debt that India has, including government borrowing, household, and companies or corporates, as a percentage of the world debt is 2%, but the interest that we are paying is 10% of the world interest that is getting paid. So we are over indexed 5 times, and that is impacting our PNL. Now, we are also the only country or only large country wherein debt to GDP is actually being contained in a much better fashion compared to where it was pre GFC. So in a relative world, I would say while we have a very high cost of capital, I would think that over the course of the next decade or so, this gap will reduce. It's not going to come to 2% or 3%, but will it remain at 10%? I don't think so. I think we are going to come down to 8%, 9%. So at the margin, things are improving. Again, on the capital side, like we've, I think, discussed, cash flow from operations is at its best. Debt to EBITDA of corporate sector is at its best health in the last 20 years. So I would think that, on the capital side, things are looking better. It can obviously improve a lot more for us to become super competitive. But given where we are starting out, I would take that as a small positive. It's nothing big. Labor, like we discussed earlier on also, the cost of labor in China compared to the cost of labor in India, I think the gap is widened quite meaningfully higher. Of course, what matters is just not availability of labor, availability of skilled labor, and which is where clearly we have a learning curve. But I think we are starting to get our act right, is what at least our discussion with various companies, etc. But again, the road to improvement is a long way. It's only the marginal delta that I'm speaking about, but it's in the other 3 4 other factors where I think things have improved quite meaningfully. So if I think of energy, because of our inefficiency of the past, which is clearly that agriculture has always been subsidized. Residential has been somewhat subsidized, which meant that industries used to pay the highest power cost, and the fact that SEBs were always perennially broke. You also had unreliable power. India is the only country, in my opinion, where 50% of the industry's total power is captive regenerated. I don't think any other country comes anywhere close to this. So, because of our inefficiency of the past, I think we've made a significant improvement as far as our energy mix. It's still high, so it's not that others have obviously countries like Saudi, etc. The cost of energy is very low, but our delta, and clearly we saw it in Europe and even in China, where in last 1 year there has been a significant spike up in energy. I think in India it's been far much lesser, which brings in predictability. If I look at the fourth factor, which is that of currency, I would say that there is a meaningful positive delta over there as well. So our biggest competitor, of course, is China. CNY INR used to be 9.5 to 10 from 2015 to 2019-20. Today we are close to about 12. Again, I'm not saying that depreciating currency is always going to give us dividends, but I would think that this is the first instance that I know of wherein we have depreciated at a reasonable relative position of strength of the overall economy. Typically, our depreciations have happened, during when we were fragile and we had to devalue, etc. This time, we've actually done a lot of things right, and we are in much better shape in a relative world, and therefore this depreciation is positive. And then you've got the all the other things. So by and large, I would think that the broader confluence is looking good. Of course, we'll have to still wait and watch and look out for companies. So within that, of course, be it industrials, capital goods, auto anks, etc. All of that, one can pick and choose from. Where is it that this edge can be improved upon? And that is where I would think it can be a framework to help you.
Right. So, Investor Hub, you can unmute and ask your question.
Hello, sir. I hope you are doing good. So my question was actually for the mutual fund industry and fund managers industry. That we all know that most fund managers can't beat the index, and research analysts estimates are wrong. So after having so much of data, premium data sets, after having full teams who work on picking stocks, but still most of the manager in industry cannot beat the market. So my question is, what is the point of spending so much money on the research, like Bloomberg terminals and capital like is so expensive? So what is the point of
Sure.
investing? It is an overall question, not to you. It is an overall
No, no,
industry.
no.
Yeah.
So I'm aware of this active passive debate, and obviously we have our views. So, but I mean, I'll try and nuance my answers. Hopefully, add some value. So, see, firstly, this outperformance, underperformance is cyclical, right? So that, and these are long cycles. I'm not saying that 1 year we do well and the next year we don't do well. So there are two, three. If you have not looked at that, I posted this because it's a bit technical and I don't want to waste everyone's time. I'm not elaborating it, but I posted it on my Substack called "Benchmarking the Benchmarks." Okay, so it's possibly gives you a peek as to why I think it's not that totally a lost cost for active managers. But at the end of it, I think at the core of your question is, what are we doing with so much of research, or what are we doing when we get the estimation wrong? Yeah, because then what is the point? I think so. Over here, I have a slightly different take, which is that the job of the analyst, a good analyst, is can be defined in two ways. One is to get the earnings right, and second is to get the assessment of the business right. The assessment of business right is not necessarily estimating what the EPS will be and what the PE ratio is. The assessment of the business is, in my opinion, is has the business maintaining its edge over its competition in whatever form or shape and however you want to track it. Will this business be better off in the next 3 5 years than what it is today? And what is the price telling me today? Uh, and this assessment, I think, can't be quantified so much in the form of estimates. And over there is where I would think a lot more focus needs to go in, and that is where I think analysts need to be judged upon. I'm not a great believer of looking at earnings estimate. Obviously, they matter for a certain set of investor participants, but I think that there is no shorthand for outsourcing all our work to the markets. Obviously, markets are made of a collective. Yes, it is competitive, it is tough, all of that. But if you've got a process and you've got discipline, I don't see it as something that cannot be done. So I know it's a wishy-washy answer, but if you've got time, I would strongly urge you to look up that Substack, beating benchmarking the benchmarks. Maybe it'll give you a sense as to why I believe that Indian benchmarks aren't all that great as what is being spoken about. Obviously, I'm not being dismissive about them. It is still extremely difficult to beat them. But if you've got a process, I think there is a good chance that we can. So we all have to be slightly different. We can't be doing what everybody else is doing and believing that all of us are going to outperform. So I think that's the way I would look at it. I would not be totally dismissive of our efforts.
Right. Yeah, Kaushik, you got your hand raised. You.
Right. Thanks, friend. I would just add on to what Sir was telling. It's not about analyst being wrong on his EPS. It's more on like analysts wanted to be right on the direction of the EPS, and that actually matters a lot than what exact number is. And sir, I have a question for you. I just wanted
Sure.
to understand, are you going to do deep dive onto on ROC, and if you're going to do deep dive on ROC on their viewpoints, what exactly that you concentrate? Are you concentrating on returns on asset turns or profit margins? What makes you more happy?
So I think there is what makes me happy is actually identifying companies which I call it as super compounders. What is super compounders in my view, and this is my nomenclature, maybe there is actually a term for them. It's basically to identify companies where sales, which is today, will become profit, say 2 3 4 5 6 years down the line. And if that profit pool can be generated through internal accruals, nothing like it, right? So with that being the objective, if I were to break the DuPont into asset turns, into profit margins, and then of course the leverage factor. Obviously, as you also rightly said, the leverage factor is not something that I would focus a lot on, because primarily we are looking at internally accreted reinvestment rather than potentially looking for constant access to capital markets. Between asset turns and net profit margins, I would say that anything which requires only the income statement is a lot more manipulatable or a lot more variable. Let me put it that way, not manipulatable, variable. And anything that requires a balance sheet is slightly less mean reverting. And therefore, I would give a lot more weightage to the asset turn aspect than to the net profit margin. But again, this is obviously contextual. You have to look at it from a competitive and a sector perspective. But purely, if you were to ask me between these two ratios, I would pick anything that involves a balance sheet or the cash flow than for a pure ratio which only focuses on the profit and loss. And I'm saying this as a very generic thing. Obviously, yeah, for each company it will be different.
Thanks, sir. If I get a chance, can I ask another question?
Sure.
Sir, in asset turns, are you more concentrated on fixed asset turns or working capital asset turns? Or like what motivates you a lot in this side?
See, ultimately, working capital asset turns is, primarily what the what to say the track record primarily has been, in the sense that companies tend to have working capital cycles which don't change dramatically. If a company has been reasonably tight on working capital, it's not that the company will suddenly, by launching into a new product, completely change its overall working capital cycle. Because that's the toughest discipline, if you ask me, to have. Because obviously every manager is more focused on sales, and to get the sales done, they may want to relax their receivable cycle, right? So companies which, so I would say that a company which is actually very poor in working capital cycle, typically, in the past, I don't see how they can so easily fix it. So I would give working capital a lot more focus on from analyzing of the past. The future is any which case, we don't have too much of a sense about how working capital, etc., can change. And the idea is not to have accuracy. The idea is to get a sense of where things can be. On the fixed asset turn, I would say that it is very difficult in the sense that if it took a particular X crores to put a plant, given the technology and given the improvements that are there, possibly that today's X can potentially give even 2X or 3X the returns. And therefore, is it good enough that they say that, we'll get 2X returns? I think what matters, like I keep saying, is the relative thing. If somebody else is spending X in that particular sector and is getting 3X and you're getting 2X, I would say that you're not doing that great a job. So fixed asset is still a function of technology, macro variables, etc. Working capital is an internal discipline. So I would say that working capital is something that I would focus a lot more to get a sense as to whether the management has got the discipline or not. I hope you're getting what I'm trying to say. Okay.
Kaushik, are you clear on it, or got
Yes,
further
yes,
follow up?
Prince, I'm clear on it.
Okay, great. So, Harish sir, although you touched upon the aspect of risk management, so again, broadly, if we're to discuss how you see when it comes to risk, and what all strategies are in place so as to minimize it, that we get
See,
the best of
uh,
return, risk adjusted returns per se.
See, my personal view is risk can't be outsourced in the sense that most investment management teams have got a front office, which is the investment team, and then they have got a mid office, which is into risk, etc. I don't think honestly that's a great idea. I mean, I'm not saying that that's not going to work, etc. My personal belief is the front office has to don the hat of the risk while making the investment. Risk is not a number, or it's not a byproduct that you can focus on, as an Excel sheet saying that this is what your risk is. That's my personal view. And therefore, if you have it as an input variable into your decision making, it will show through in terms of your weighing schema. It will show you in terms of the factors that you are considering right at that time. And obviously, you will still make mistakes. Obviously, it's an iterative process. But to outsource it, I don't think so. So therefore, my thinking is that you've got this whole bunch of quant, which is in terms of say factors. It could be in the form of exposure level, how you're looking at all of those risks do come through. But beyond a point, I'm not a big fan of value at risk and scenario testing, that in GFC, if this portfolio were to happen, how it will fall, etc. I think those are all theoretical and good for academic or textbook kind of a thing. I don't think real life. I would not place a lot of credence. So I would say that risk management has to be ingrained in the stock picking selection, which is that are we giving more focus to internally accreted cash flows than to accessing capital market cash flows, or capital market capital lines. How is your overall discipline being? I would look at, for example, very strongly from an attribution report, whether your returns have come through from very few sources, or whether they have come from more positions. And I would think that for example, if I were to look at my attribution over the course of the last 10 years in India, by and large, no one position would account for more than 10% of total returns. Now, I am not saying that's the right way, but in my view, I would say that, it at least means that I've got a repeatable process wherein not all returns are coming from one stock, which once that stock runs its course, I don't know where to reinvest and find a similar idea. So I would say those softer aspects is what I would look at. I'm not a very big believer of Excel sheets and, all of those value at risk kind of concepts.
Like when it comes to position sizing, is there any upper capping on like single investment or like how it goes?
Okay, so obviously there are caps from a regulator point of view, etc. Right, but it is also contextual. I mean, the way we look at it is more active share, weighing schema. So obviously we all have benchmarks that we endeavor to outperform, and so we look at how our differentials or active share is on each position against the benchmark, and it is that active share that we are trying to have a weighing schema. Like I said, I'm of the believer that equal weighted active share is actually a good point. And with time, then you can always have greater conviction. Like I said, when I look at my attribution, the fact that no one position has given more than 10% kind of demonstrates that it is slightly more diversified. At least that's been what has given me greater peace of mind. And so that is the we've published some work, I think, on the equal weighted, and from a pure quant approach, I would say equal weighting has got tremendous positive abilities. I mean, I would think that equal weighted is possibly very underrated from a concept. So I would give a lot of focus on equal weighted strategies. But from an actively managed fund, I would say active share equal weighting is where I am more comfortable with.
Right. Although like you touched upon the sell strategy, but broadly, like what all criteria you use before selling a position? I mean, is there any fixed criteria or that also evolve with a period of time?
No, no. I would say that the selling criteria is still evolving. In the sense that the buying criteria, I think, and I am not only saying for myself, I would say for most of the professional managers in the last 10 years, the buying criteria is reasonably similar. Obviously, some may have a higher emphasis on valuation, some may have a higher emphasis on management and business, but by and large, I would say that most of us have realized that quality businesses, longevity, blah blah blah, whatever I have spoken about, I would say that most of it's where the selling is concerned, where I think as an industry we are evolving, in my opinion, and definitely I can speak for myself. I am definitely work in progress over there. Uh, so over there, like I said, where narrative keeps changing every 3 6 months, that is the one clearly that is a red flag for us, because generally we are very patient with our investments. We don't really we're not playing the fact that sectors which are going through a bad patch will exit, etc. The one thing is, of course, that when they're going through a bad patch, we may not want to increase our exposure just because they get cheaper. We would still want the sector dynamics to get back into place. But our belief is that in every sector, if you buy the best of breed, and as long as they are improving their edge in a subjective fashion, obviously it's subjective, we would want to persist with them. So we won't want to sell. So when times are bad or when there is a regulatory action that has happened, and so the first thing that we do is we don't buy. We don't buy anything. We don't average down just because we are not sure, and the reality is I don't think, like I said, we are operating with 65 70% of information. Anybody who, in my opinion, who says that we should average down, possibly either they may be operating at 80 90% of information, or maybe they have a different process. At least I can't because there will be phases, there will be curveballs that will get thrown up, which you will never be able to anticipate, and therefore we don't want to compound the error by adding exposure to it. We will let it run and down. The The third level of selling is obviously when some stocks go up and are typically the thing that really we look at is whether the company can reinvest the profits that they can make and continue to maintain their ROE. And in a lot of cyclical or sectors, for example, there were some of these platform companies that got re-rated significantly post COVID. I'm just giving you an example to give a sense. They suddenly were talking about making, say, 1,000 crore profits. But the key question that we keep asking is, can this 1,000 crores go back into the company in the form of business and continue to generate the ROEs? And while the street was giving it, say, 20 or 30 or 40 times PE on that, our sense was that if it cannot regenerate the same kind of ROEs, these valuations are suspect, and therefore we would want to sell out. So that's the thing that I look out for when I look at selling.
Right, sir. So, sir, like although any good literature or book which has helped you in your journey, or maybe that could be beneficial for our attendees. Any recommendations of book?
So yeah, I think Capital Returns is, I think, the finest book, especially for professional money managers. I think it was something that helped me evolve. This is the book written of the investment letters of Marathon Asset Management, and clearly, the focus of looking on supply side and demand side, at least for me, got distilled after reading this book. Another book that I really like a lot, which may not really be appealing to investment professionals, is Creativity Inc. This is the book on Pixar. I think that our business is not about numbers. It is about finding the right creative sparks and pattern seeking. And The fact that Pixar has got what 20 hits, hit after hit, in an extremely difficult creative business, that book explains the process more than anything else. And I think that's the process that I would definitely think that we should try and imbibe in our investment processes as well. So that's the other one. Paradox of Skill by Michael Mauboussin, again another good one. And recently, of course, I read this book, which I think I should have read maybe 20 years back, which is The Economic Organization of a POW Camp. This is written in 1945. It's a 14-page white paper. You will be able to download it in many places. And I think that's possibly the best book that I've read, which will tell that how, because I mean, very simply speaking, in a POW camp, everybody is given the same ration, right? It's a socialism, but even as all the prisoners are given the same set of quotas of cigarettes and whatnot, and food, etc., how from socialism capitalism comes, how arbitrage comes, how futures markets come in a prisoner of war camp, sitting in 1945, to my mind, explains the behavior as to how markets function. So I would rate that as possibly the number one book in MBA classes should have, to distill the importance of markets and how markets evolve organically, even though the initial starting state is that of socialism, and how capitalism eventually comes through. So I would say these three, four books have had a good influence on me.
And like we have so many investing idols. So any name in particular who has influenced your style of investing, or maybe inspired you big time? Maybe from the West, or maybe from our country.
Yeah, I think that there are many people whose qualities I admire. But I'm of the camp that I don't want to keep anyone in a pedestal, that puts them in a spot wherein they are going to fall. So quite honestly, I have no idols as far as investment is concerned, because no one is perfect. And therefore, to put them in a pedestal, actually, I would say, demeans them, because the idea is everything is contextual. The decisions that people took, at that point of time, there's no. I mean, I'm not a very big believer that reading biographies of investors, etc., I mean, ultimately, it is how we are going to decide at that point of emotion that is going to determine our outcome, and that can never be brought out in a book, in my opinion. So, I would say that I have zero investment ideas. I mean, I hope I'm not sounding arrogant, but I respect a lot of peers, clearly, but I wouldn't put them up in a pedestal.
Right, right. So, like Harish, we had some requests from our attendees, but again, there was some glitch and couldn't take those questions. And I tried holistically to cover all the questions I had. So any closing remarks or maybe anything which you had in your mind and I forgot to ask you, so you can add that with
No,
your
no.
closing remarks.
I think it's been a long thing. My only one request is, obviously I have revealed a lot of our mistakes. Please take it in the spirit of learning. I don't want anything from the sense that professional money managers are reckless, etc. So it's an evolution that I wanted to share. And to think of from a first principles approach. Of course, we didn't cover some aspects of synthesis and bundling and unbundling, but I guess it's been a long day. Maybe at a different forum, we can cover those. But thank you, Prince, for this thing. Like I said, this is the first time I'm doing something like this. I don't know if it helped any of you, but I'm grateful for the opportunity. Thank you.
Thank you so much, Harish, for your time, and surely like look forward to maybe second part of it and the aspects which you just mentioned, which we can cover in that, and surely look forward to many more learnings from you. And thanks for agreeing to doing this. It was really insightful on your part, and for our attendees who joined late, the session is recorded, and I'll be placing it over YouTube very soon, so surely you can revisit the session as and when you feel comfortable with time. So with this, I take your leave, and surely it's a great value addition. And guys, like as Harish has also pointed out, the whatever the discussion was, it was from educational point of view, and whatever he has said in personal capacity is in good faith only. So he has kept his view. So you can take that as a starting point of your learning, and surely look forward to much more learning in time to come. So with this, I take everybody's leave. Thank you so much, and surely you can connect over Twitter handle of Hari sir, and surely you will find so much of insights over his and also like he post his interaction over there, so that you can also get access to that. So thank you once again. Thank you, sir.
Thank you. Thank you. Good night.